Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
It's your boy Andy, and welcome back to the DeFi Slate YouTube channel. Smash the like button on this video, that really helps us out, and sit back and enjoy the content. Thank you very much.
What's going on, guys? Welcome to episode 74 of the DeFi by Design podcast. Here today to talk about some really interesting stuff going on in the DeFi space, what's being built. And yeah, it's been a wild ride out there the last weeks. If you've been following along the market, I mean, with this UST collapse was just insane, followed by Bitcoin falling apart, followed by all this other jazz that's been going on. It's been wild. We've just been building, been working, been learning, been expanding what we're doing. And yeah, excited today to speak with Alec. Alec is a co-founder of Sperax. Sperax is an Arbitrum native project. We love Arbitrum. We love layer 2. So anything that's Arbitrum native is usually something to pay attention to from our experience in terms of the quality of builders and tech. So always excited to learn more about what's going on over at Sperax. Without giving away too much info, I'll pass it on to Rob. Rob, how you doing, bro?
Doing well, man. Yeah, kind of like you said, markets are topsy-turvy, right? They went up a bunch, they went down. Volatility is kind of getting sucked out of the market. So, yeah, don't overtrade. There's definitely some opportunities out there, and we'll talk about a few today on what's going on over at Sperax and the interesting mechanism that they have over there to help yield generation. And yeah, obviously, the UST collapse kind of threw a wrench in the algo stablecoin mix, but it really unveiled kind of the difference between algo stables and Ponzi stables, and we'll touch a bit on that today. So yeah, I'm super stoked to talk to Alec over at Sperax, and yeah, Alec, how you doing, man? Good to see you.
Hey guys, Andy, you're up. Thanks for having me. Great to see you guys as well.
Yes, sir. How'd you get into DeFi, and kind of what led you to think about Sperax?
Yeah. So my entrance into DeFi was kind of unique, I guess. In 2016, I was a sophomore in college, and I had some buddies that were upperclassmen, and I wanted to go to the bar with them. I wanted to go get some beer. So we were in the market for some fake IDs, and the only currency that these websites accepted was this thing called Bitcoin. So in 2016, we bought like 30 Bitcoin to pay for like a couple $100 order, and we had a couple Bitcoin left over. So in 2017, that started running up in price, and we were like, what the hell is going on? So we found a couple other students interested in Bitcoin and crypto, in blockchain. We found a couple of professors as well in the finance department that were keen on it. And then we started the Market Blockchain Lab. So that was my first kind of experience in crypto. And that was like a student-run research facility kind of club. And yeah, that's how I first got plugged in the 2017 cycle and got absolutely wrecked in 2018. But
Same.
Lived to tell the tale.
Yeah, I got wrecked on BitMEX, man.
Thank God I wasn't dabbling with BitMEX. I was just holding spot, and I was kind of up in this like boat of believing that everything was going up and to the right. So that was a very humbling experience for me as I was doing public talks, like encouraging people to get some exposure in mid-2018. It really forced me to figure out what was going on under the hood once the asset prices started dropping. So it was a very exciting time to join, but very rapidly it became really sobering. And I had to really figure out what was going on underneath the hood.
Yeah.
It's tough. Like once you kind of catch the bug and almost see the inevitability of the value that it brings. It's like, well, how could this thing ever go down? But just in the midst of the macro environment, there's still a strong correlation. And kind of way back when, right? 2016, there wasn't that correlation because it was almost not even treated as an investment yet. It was just like this new form of technology that people were getting exposure to, but it didn't have that same kind of like connotation as an alternative investment. And it was like still uncorrelated, and then kind of now as it's become more like integrated into traditional finance, it's really become correlated to the macro environment. And now we're all kind of like, well, is this correlation going to stick around, or is it going to break? What do you think? Like ultimately, is Bitcoin kind of like embedded into traditional finance with this correlation we're seeing today, or do you see a path to its own mature asset class?
Yeah, I think that there's two schools of thought there. So first off, I view it in more of the traditional financial risk spectrum, being as far right down the risk curve as possible. So if a sell-off of risky assets are going to happen, if you subscribe to that school of thought, Bitcoin, Ether, all cryptos should be sold off first to cover margin on less risky assets like equities, and then those are sold off to cover positions in bonds, real estate, etc. So if you believe in that, you would expect a pretty significant correlation. But then there's this other school of thought that I really subscribe to, which is, this younger generation of internet native Gen Z type individuals. One, they have no idea how to even access equities. They have no interest in purchasing bonds. So this cash that they have, when they think of investing, they almost are immediately thinking of cryptos to begin with. And then the riskier play for them is something like an NFT. So for these individuals, they might view, equities as a risky play. So any investment capital coming from Gen Z may filter right into the asset class they're most familiar with, which would be Bitcoin, would be Ether, would be crypto. And there's something really unique, which is the fact that a lot of these Gen Zers, man, they're incredibly rich. They're YouTube stars, they're TikTok stars, and they actually have incredible amounts of buying power. So there might be the silver lining of equities, shitting the bed, but crypto's continuing to hold strong simply because it is the asset of choice for the next generation. And if that plays out, we could see a decoupling, which is going to be a really exciting time over the next couple of years.
Fair enough. Exciting times indeed. I mean, we're looking at just an unprecedented kind of world order right now. It's pretty wild to kind of unpack everything that's happening. But in the nitty gritty, we're still building in DeFi, kind of taking products, from stage 1 to 2 to 3, and it's been really interesting to see the evolution of all this growth. Now, now we have all these different chains, and now we have these layer 2s and eventually layer 3s and ETH 2.0 and all this other really cool stuff happening, almost like within our little bubble. That is affected by Bitcoin being like a macro instrument, so it kind of drives the rest of the market, but it's almost like already decoupled and uncorrelated in the sense that, especially even like NFTs, obviously with like the risk parameters and kind of liquidity concepts, you see trends emerge when everything's up and everything's kind of down, but we're kind of in our own bubble here, which kind of brings me to the point of what you guys are building at Sperax. So I'm curious why Arbitrum? How did you guys get involved with Arbitrum? What's your thought process behind Arbitrum? Kind of how did that become the landing point for Sperax?
Yeah, great question. So the decision was actually fairly simple once we kind of took a first principles approach. So we knew that Ethereum Layer 1 was pricing out a lot of the newer retail users, and building a high-yielding stablecoin product, which we'll get into, our primary user base is not like this risk-on degen type character that maybe is an expert at interacting with blockchains and maybe has a big purse. willing to pay the layer one gas fees. We just didn't think that that was our target market. So we needed a accessible blockchain. But back to this notion of we're servicing newer crypto users, we didn't want to sacrifice any security when delivering the cheaper gas fee experience. So we figured, okay, what's still like hyper secure, but still delivers cheap gas fees? And we basically started investigating popular alternative layer ones, but growing up and being introduced to crypto first through Ethereum, I just didn't see the decentralization or the censorship resistance principles in those ecosystems. They were much more willing to sacrifice decentralization in exchange for transaction throughput. And I thought that that was a cool short-term solution, but it didn't seem to really resonate with me as a long-term arena to host this new censorship-resistant financial system. So we began looking at some alternatives, and we are, Ethereum OGs, and really we're watching the layer 2 scene. And when we learned about optimistic rollups and the ability to borrow the security guarantees from Ethereum, but still deliver significantly cheaper gas fees, it was a no-brainer for us. We basically believe, the newer users need the cheaper gas fees, but the larger net worth users won't trust bridges, and the perfect happy medium there is Arbitrum. The Ethereum whales are happy to use optimistic bridges, and the new users are happy to use Arbitrum with the cheap transaction fees. The next barrier is just to figure out all of the various ways to get capital into Arbitrum, which we're working on as well. But I'll pause for now.
Yeah, I mean, it's the biggest layer 2 by liquidity in TVL. I think now Optimism has been gaining some traction, but you guys could always deploy on other layer 2s as well. It's not like it has to be only on Arbitrum, but interesting kind of thought processes. I completely agree. I support all Arbitrum projects. I really support all layer 2 projects over anything else right now. I mean, obviously ETH mainnet projects are great, but like anything even on other chains is just like, I don't know. I don't see the value of being on a different chain when you can, exactly as you're saying, get the security of Ethereum, same, kind of cost and speed benefits. Would love to kind of learn more about the mechanism behind USDS, how kind of like the auto yield kind of works, how you guys came up with that idea. There's a bunch more questions, but yeah.
Yeah, for sure. So there's a couple different points I want to touch on. First, kind of like what Sparex is, if that's okay, and then I can talk about kind of like our backing, and then how we, maintain our peg. Maybe we could hit that. So first off, Sparex is a software development company. We build financial software, but instead of like keeping that software code a secret and monetizing the code that way, we do the exact opposite. We publish it open source. We deploy it on public blockchains. So anyone can go tinker with it, can fork it, can play with it, can improve it. They can do whatever they want with it, And our first financial software product that we built is a stablecoin that generates passive income for holders at a rate of 11%. And our basic, thesis is that crypto should be easy, and right now it's quite challenging, even for experienced users. So we want to remove all of the complexity and the anxiety around simple DeFi stablecoin activities. So let me explain a little bit how it works. So I just want to make something go ahead.
So real quick, like immediate first thought that somebody's going to have is, how can you guys get 11% if, my bonds are only getting me right now on a 10-year 2.5%?
Yes. So all of our yield that is generated is 100% organic, and we use zero inflation benefits from our protocol. So we don't subsidize a penny. And let me explain that in just 1 second. But little secret, it comes from our 100% collateral backing. So we are a stablecoin, but unlike other stablecoins, we are 100% backed. So each and every USDS that's out in the market has at least one USDC or at least one USDT sitting in the reserves ready to be redeemed at any point. So when you're holding this thing, you can think of it basically just as like a receipt token. So now you're given the right to go to the website or our protocol at any given time, and you can burn your receipt token, and you will be given one USDC or one USDT for the receipt token. So I just want to make that very clear right off the bat. And the collateral and the reserves are actually what enables our stablecoin to remain pegged, and it generates the auto yield. So first off, on the peg front, it remains profitable because of this redeeming process. So let's just go through 2 quick examples. Let's say hypothetically USDS is trading off its peg and it's trading at 95 cents, so under $1. Because of our collateral and the reserves, arbitrage traders can have confidence that if they buy that USDS on Uniswap for 95 cents, so basically you're catching a falling knife at this point. You're buying a depegging stablecoin. But what you're doing is you're buying that stablecoin for 92, 93, 94 cents. You're then going to the protocol, Sparex USD, and you can deposit all of those stablecoins that you just paid 93 cents for $1 worth of USDC. So then once you get your $1 worth of USDC, you go to the open market and you sell it on the open market. That arbitrage trader just made a 7% arbitrage profit. The value of the stablecoin is back to $1, and the holders of the USDS are happy and sitting dandy with their $1 peg. The same thing works in reverse. So if it's trading for over $1, you as an arbitrage trader can send USDC to the protocol, which will then mint equal amounts of USDS. But the USDS is trading at a premium in the open market. So now you just paid $100,000 for $105,000 worth of stablecoins. So you sell the USDS on Uniswap, you take the 5% arbitrage profit, USDS becomes $1, everyone's happy, arbitrage trader made profit, the stablecoin's back to $1. And this is just very important to note that without explicit collateral, that arbitrage trader won't do the trade. So that'll come in later. I'm sure we'll talk about some other stuff. But so the same collateral pool that allows for the peg to remain stable is also what generates the auto yield. So all of the collateral sitting in the reserve is sent to various DeFi protocols. Right now, we only use Curve just because it's the most trustworthy and risk-off. And then once the stablecoins are in Curve, they generate trading fees and they generate CRV. And then that CRV is sold for more USDS, and the USDS is then sent to anyone that's holding USDS in their wallet at a rate of 11% per year. So we don't have to subsidize a thing. All of the yield is generated from our collateral reserves sitting inside of Curve positions. And we're using the Curve 2 pool right now in Arbitrum to generate that yield.
Awesome. Alec, that really paints the picture of I think the 2 questions that are begged right away, which is how does USDS maintain the peg? And you mentioned it's this mechanism of kind of economic enforcement when arbitrage traders can mint and burn directly with the protocol and interact with the fully backed reserves of USDS. This is, I think, really important to highlight the difference between these algo stables that are fully backed and then what I would call, Terra a Ponzi stable, where a portion of those reserves are just, thin air, and you don't really know. You just kind of have to trust and have confidence in those reserves to back the stablecoin asset, which we've seen obviously is a flawed model.
Can I speak to that real fast?
Please, yeah.
I just want to point out the fact that, so as we just talked about, if the peg is deviating down, say USDS is trading at 95 cents, you have to have a really ballsy trader coming in to buy that stablecoin, right? Because everyone's thinking, oh shit, it's going to go to zero. But once you have a collateral pool that has explicit stablecoins in there, it gives that trader confidence to buy the discounted stablecoin because they know they can go to the protocol and get 1 USDC for it. Where in the Terra UST example, when UST was trading for 95 cents, no one wanted to buy UST because all they get is Luna, and Luna was going to zero rapidly. So all of a sudden, anyone looking at UST, they go, I'm not going to buy that shit. All I'm going to get is Luna, and Luna's going to zero. So introducing hard external stablecoin collateral maintains that peg, but also gives us that dope benefit of being able to deploy strategic capital to generate auto yield, to make our protocol safer, do a whole bunch of stuff. So I just wanted to kind of point that out. That's kind of why the UST. No one wanted to buy UST because all you got was Luna, and Luna was shit in the bed.
Right. And there's an element of transparency that an open source protocol with decentralized smart contracts offers, like Sperax does, over and beyond something like Tether, where there isn't transparency into what their reserves are, so you don't fully understand or have confidence in that one-to-one peg to hold up, because it's not a fluid, transparent model where you can see, okay, this is fully backed. Even though they do have audits, it's still kind of a matter of trust. Whereas there's actually like a block explorer. You can go check the contract address to see the amount of USDC and USDT in the Sperax contract at all times, and make sure that the two sides of the equation are balanced.
Yeah, you got it exactly. Like, people trust Tether because for every USDT, I'm speaking as like an institution here, because you and I, we couldn't, but if we had a fund, we could redeem USDT. So you think, okay, sure, they got like 80 billion circulating. They probably have at least 50, 60 billion in reserves. I'm not going to eat up all 60 billion worth of reserves, but someone might. If there's a bank run, you don't actually know how much they have. And the glory of Sparex USDS, as you mentioned, Rob, like if you see 15, 30, 50 million of USDS outstanding, you can go check our reserve contracts, which are right on our analytics page. And you can see that there's $1 for every USDS outstanding, which then just gives everyone the confidence to be holding the currency, because the protocol would work down to the last circulating USDS. Like we could have a bank run all the way down to 99% of our stablecoins being redeemed, and the protocol would still work perfectly fine. Our governance token probably wouldn't perform too well, but like the protocol can operate with just a single USDS outstanding, which is pretty cool.
Yeah, and go ahead, Rob.
Real quick, the element of transparency also opens up the entire market to the arbitrage traders. Whereas, like you mentioned, only institutions are able to arbitrage the Tether peg because only institutions can redeem. But in this on-chain, more peer-to-peer world, it opens up all of these market makers, liquidity providers. Anyone can be an arbitrage trader and take advantage of those opportunities.
Yeah. On that note, real fast, this arbitrage to maintain a pegged asset is nothing new. So this is an Etf Style Arbitrage, which you can, everyone can go check out on Investopedia. basically if the pegged asset is deviates from the peg, you can redeem underlying and it will bring it back. But Rob, as you touched on, like, it's only available for accredited investors. So now these cool financial primitives are becoming democratized. And we saw it first with liquidity provision with Uniswap. Anyone can be an LP now. But I'm excited for these a little bit more exotic strategies like Etf Style Arbitrage being democratized as well. So we're going to see a flourishing market for this type of trade and this type of activity from retail in the coming years as well, which we're stoked on.
Fair enough. Yeah, that ability to access the all these protocols just with a Wi-Fi or your own Wi-Fi and MetaMask is just, I mean, it's crazy. It's truly democratizing the entire landscape. I'd like to kind of dive into some of the pitfalls as to where Luna and UST went wrong, and kind of what your thoughts are on the general state of stablecoins in DeFi. Perhaps we could like kind of go through and explain to our listeners some of the different types and kind of risks involved. So let's start with UST and Luna. Kind of what are your thoughts overall on that kind of algorithmic stablecoin concept? Like, do you think those are done for? Or do you think there's any way to make it work? What are your overall thoughts on the algorithmic stablecoin concept?
Yeah, I'm trying to introduce this new mental model for stablecoins, which is something that I want to call a redemption-based stablecoin, because at the end of the day, like Maker, it's just a bunch of algorithms in a smart contract on Ethereum. Like, I don't know how that isn't an algorithmic stablecoin. There isn't like some, Rune isn't sitting there like managing all of these trades and managing the DAI savings rate and stuff. Like, it is an algorithmic stablecoin. So I view two large categories of stablecoins being redemption-based stablecoins, which is the old algorithmic version, or we have CDP model stablecoins, collateralized debt position stablecoins, which is like Maker DAI. So the Maker DAI system, I just want to kind of paint this picture real fast. A user locks ETH, they mint a stablecoin. If ETH goes down to their collateralization ratio, the ETH is sold, the user keeps the DAI. Or if a user sends the DAI back to the protocol to close their CDP position, you get all your collateral back. So say you locked in 1 ETH, you minted some DAI. When you return the DAI, you get your 1 ETH back. Okay? These are extremely robust stablecoin mechanisms, and they've done an amazing job maintaining the peg. But there is a very glaring problem. The problem is that these are not stablecoin protocols. They're decentralized leverage protocols. So the implication of that is when demand for leverage dries up, so basically when people stop depositing ETH to mint their DAI, no more DAI gets minted. So if people think the value of Ether is going to go down, they're sure as hell not going to deposit Ether into a leverage position, which is what minting DAI is. So these systems are very, very robust, but they don't scale. They only scale in bull markets. In bear markets, they completely dry up, and you can check the performance of DAI in 2018 to 2020 to validate that. So that's the CDP model. Brilliant, but doesn't scale. The second model, which is the quote-unquote algo stable model, I'm trying to rebrand as redemption-based model, is basically how USDC, USDT, and all ETFs remain stable. And there's something really important to note, that these redemption products have a risk spectrum. So they can go all the way from 0% collateralized all the way up to 100% collateralized. And there are trade-offs when thinking about where you want to lie on that risk spectrum. So on the far left, being the most risky, was UST. Some people call these Ponzi stables, and they work very, very well in bull markets as well. They can actually scale incredibly fast because they require no external capital. So let's just kind of look at this high level. Far left, UST, backed only by Luna. If Luna's going down, no one wants to arbitrage. So when Luna goes up, everyone's happy to arbitrage. Hell, everyone's pumping money into it. It's amazing. And because you require no USDC or USDT, you can do a lot of cool, fun incentives to basically juice up your growth. But in the event that you hit a bear market, people stop arbitraging. Okay, so that's a 0% collateral model. Then you can enter the middle, or maybe a little bit farther on the right of the risk spectrum, which would be something like Frax. So Frax is actually a hybrid. For every Frax that's outstanding, one stablecoin of Frax, there's 85 cents worth of USDC, and then there's 15% that's unbacked, that in the event of a bank run, the protocol will mint the governance token. So these work well, but in the event of a bank run, users are still going to be given at least some portion of collateral in FXS, which if FXS is decreasing rapidly, users may be not so inclined to arbitrage the price back to $1. So Frax has actually done an exceptional job, and maybe 85% is the perfect collateral ratio. But for those that prefer a little bit more security, USDS is 100% collateralized. So we're on the far right of the risk spectrum when it comes to redemption stablecoins. We have one stablecoin for each and every USDC or USDS outstanding. And basically, the trade-off here is more collateral makes it a little bit harder to scale, but you get tighter peg stability. And as you introduce more of an algorithmic component, so a part collateralized by your governance token, you add more scalability, but you reduce the ability to generate auto yield, and you introduce more risk into the protocol. So to summarize, you can go all the way from 0% collateral all the way up to 100% collateral. And Sparex USDS, we've elected to start at 100%, and then we'll allow the DAO to decide how algorithmic we become over time. And the role of the Sparex Foundation is to basically be an analyst for SPA holders. So we'll educate the community on what are the implications if we become 90% collateralized. Sure, we'll burn more SPA. Sure, we can scale a little bit faster. But if there is a bank run scenario, will people still want to arbitrage? There's no guarantee. So our general ethos is we're erring on the side of security and peg stability, also on the side of auto yield. And I'm sure many new stablecoin protocols coming out will have a lot less collateral, but it's just an exciting time right now where a lot of stablecoin experiments are being conducted. And we just want to be there to satisfy those that prefer security, prefer peg stability, and are willing to sacrifice a little bit of growth in the short term to ensure we're building a hyper-robust product. So, excuse my monologue, but I hope that explained the two different types of stable coins and then the different risk spectrum underneath the algorithmic redemption model.
Yeah, that does. That helps quite a bit kind of paint the picture of, it almost seems intuitive now to 100% back, the stable coin and almost just like, confusing why someone would go towards, I would almost say previous to your monologue, like why someone would go closer to or farther down the left side of that risk curve. But after kind of understanding like more the scalability of the stablecoin in a bull market, that is apparently, the chief prerogative that maybe Do Kwon or Terra had, was to scale the network strength of this stablecoin more so than the stability of the stablecoin. And it's interesting to see how Frax has reinforced their model, and the peg has held up even in these times of uncertainty. It kind of makes me imagine like, well, maybe there's a model where when the market is going up, or even just the governance token of that protocol is going up, since that can help defend a peg, maybe there's a model where it can be dynamic in a situation where that token is going up. Maybe there's a little bit less backing, since arbitrageurs are more willing to do that arbitrage. And then the reverse, for when that market is going down, maybe you could even, you could raise the peg dynamically based on how the market is performing. Is there any like test cases you guys have done and experimented with those types of mechanisms, or from the jump you've been 100% backed, through and through?
Yeah, great question. So we actually started with such a model. Our original model was decreasing our collateral ratio at 1% per month. So 12% annually, which is a pretty significant decrease in collateral ratio. And that ratio would respond to market conditions. So if our governance token was taking a significant hit, any new minting of the stablecoin would require more collateral. So the protocol would actually reserve more collateral in the events that there might be some fear, FUD in the market. But actually, after the UST death spiral, you could call it, we elected to allow for the DAO to make all of those decisions, because we don't want to pretend like we're capable to understand what the market's going to do. Obviously, no one knows where it's going to go. So we want to ensure 100% that the protocol reflects the risk profiles of the governance token holders. So we made it 100% collateralized. It's now reducing the collateral ratio at 1% per year. So like hyper risk off. And then we are now just racing toward getting all of our DAO levers online. So then the community gets to decide. They can determine, do we want to reintroduce the dynamic ratio component? At what rate do we want the collateral ratio to decrease on a monthly or annual basis? And then also, what type of collateral are we going to accept into the protocol? Where is that collateral going to be invested to generate the income, or to generate the auto yield for holders? So yeah, that's all going to be up to the DAO, and we just had to take the position of security in light of the UST debacle.
Yeah, I really like the auto yield concept, that it's almost like these stable coins become like a protocol level layer, and then USDS is leveraging that protocol to offer this auto yield. And the reason I think it's really resilient is because it almost seems like a central bank digital currency is inevitable at this point. China's testing, US is testing, that they're all kind of experimenting with these CBDCs, and I think that'll take significant market share from the centralized kind of fiat-backed stable coins like Tether, USDC. But USDS is playing a different ball game, because you could even incorporate CBDCs into the collateral reserves and then continue to provide auto yield based off those reserves.
Yeah, absolutely. So contingent on some regulatory blockers, like ensuring that the CBDC doesn't blacklist, the contracts. we anticipate there being some very healthy risk-free rates associated with that CBDC. So we're in the process now of investigating all possible collateral additions. And, we're leading with products like Frax and Vesta, the VST stablecoin, fully collateralized CDP stablecoin on Arbitrum. We are prioritizing decentralized alternatives, but that does not mean that if a CBDC comes along, they're favorable to decentralized applications and they don't blacklist interactions. Like, hell yeah! Like let's add them. Let's generate some auto yield, and let's get auto yield passed down to those that need it the most, that may not understand how to use DeFi and would rather just go to download an app and start harnessing 11% APY, or just going onto a website and getting 11% APY. They don't need to deal with all the intimidating shit that we deal with because we like it. These people are just trying to kind of like do a little bit of investing, a little bit of savings, and we want to service that user base.
Right. Yeah. I mean, definitely the right move then to be kind of on the safe side, and just operate in that 100% collateralized, area. I appreciate the explanation of the stable coins. I think a lot of people just simply assume or the majority of the mechanisms are similar, which is definitely not the case in DeFi. You have different types, as you're explaining. So it kind of brings us to the point of like what's best. And, we haven't really seen what's best. We've seen what hasn't worked, but it'll be interesting to see kind of what is best over time for users, and kind of how to get that yield, and also ensure the most high-tech and secure applications. I'm curious what your thoughts are about the ever-growing supply of stablecoins when it comes to using them in DeFi, using them in just all sorts of applications. Like, could you see a world where there's a stablecoin market cap larger than that of like the Bitcoin market cap or the Ethereum market cap, or what's your thought process on how big stablecoins can get? Because ultimately, I mean, they're all backed by dollars effectively, or supposed to be. The ones that are like the USDCs and the USDTs. I'm curious, like, what your general model is for like the next 5-10 years of stablecoin growth, like where you might see things going.
Yeah, great question. I'm inclined to believe that this idea of like calling these things stable coins will likely disappear, and it'll most likely just be considered money. So various applications will completely abstract away the crypto or the stable coin type experience. I think we're like living in this very weird transitional period. Like, for example, like when we have kids, they're going to just be very confused that everything wasn't digitalized right off of the bat. So I think that all money will become quote unquote stable coins. The Fed's balance sheet will be this more transparent ledger, and all of the cash on the balance sheet will be quote unquote stable coins, CBDCs. So that being said, you could see a stablecoin market cap rapidly, eclipsing Bitcoins. But I think it'll just be under this very different cultural setting. It's not going to be crypto this, regular finance that. It's going to be finance. Some applications will run on crypto rails. Some will run on Swift rails. Both will have trade-offs and different user profiles that are attracted to those products. So, I would expect stable coins to actually rapidly eclipse Bitcoin, especially if we're on the early stages of a multi-year bear market. I really hope that we're not. But in the event that happens, there's going to be a lot of interest in non-volatile products and a little less interest in some of the riskier.
Especially with,
I think that's going to happen.
Yeah, especially with bond yields being low, like it's tough to get anything in fixed income right now. And yeah, I mean, if you think about all the dollars in the system right now, imagine if those were all crypto dollars or digital dollars on Ethereum, or, I mean, ideally probably on like layer twos at some point with extreme speed and low cost. Yeah, it's definitely exciting to hear. I mean, it just seems like there's so much room for growth because of like, that transitional period where there's already all those dollars in the system. It's just that they just almost need to be like swallowed up by crypto dollars, which is crazy exciting. So what are your thoughts on the current yield situation of stablecoins? Where's yield coming from currently in DeFi? Is DeFi yield is it going to go down? Is it going to go up? Is it going to get swallowed? Is it a factor of lending and borrowing? Is it the bear market? Is it a bull market? Is it better? Kind of, what are your overall thoughts, in a broad space of the current yield in DeFi on stablecoins or just on crypto assets? Where do you see it heading? What are some of the factors playing into it?
Yeah, I mean, I'm inclined to believe most of the yield comes from demand for leverage. So even yield coming from something like Curve, a lot of the Curve transactions are done from traders that are taking out, maybe minting DAI and then swapping on Curve for other assets. Or basically, whenever there's a lot of trading activity, you see a lot of activity on Curve, which then correlates to an increased yield for our stablecoin deposits. So for platforms like Curve, I anticipate the transaction or the yield to decrease a little bit, but thankfully we have the ability to juice that yield with CRV, and CRV will always have buying pressure because of the Curve wars. So I have a glimmer of hope for stablecoin yields on products like Curve. Stablecoin yields coming from Aave, from Compound, I'm a little bit less bullish on that, simply because those yields are derived from demand for leverage. So if there's not euphoria in the market, a lot of times borrowing is going to rapidly decrease. And we've already seen that with Celsius. So Celsius recently had to decrease their APR for deposits because institutions are no longer borrowing USDC to ape into shitcoins. So with the general negative market sentiment, it does dry up a lot of the yields. But something that's really important to note is our protocol actually boosts the yield on Curve. So if you have USDC, you have two options, right? You want to generate some yield on USDC. Let's just use Curve and Sperax for a moment. If you put the USDC directly into Curve, you'll earn the Curve rate on the two pool, which is 3, 4, 5%. Then how the hell is Sperax returning 11, right? Let's just say hypothetically you took your USDC, you put it into the Sperax protocol. Sperax protocol now owns it. They give you USDS. So now you have one USDS, which is yield bearing at 11%. Where does the 11% come from? Your USDC gets sent to Curve just like you would have done, and it begins earning a 5% APR. But the secret sauce here is that the only eligible stablecoins, the only eligible USDS that can receive auto yield installments are those USDS sitting in user wallets. So every single USDS that's in Saddle, every single USDS in Uniswap, every single USDS in any smart contract is excluded from the yield, because those depositors get compensated with yield farming rewards, with transaction fees, a whole bunch of other stuff. Plenty of yield available for them. But the end user who's holding USDS in their wallet, they are able to get a juiced return because all those other stable coins that weren't generating yield or are generating yield but aren't eligible for the installment, they are bypassed and their yield is given to the USDS holder with the stablecoin in their wallet. So that's how we're able to actually juice up the yield. So at the end of the day, sure, we're a stablecoin, but really we're a diversified basket of interest-bearing stablecoins, and you just have a share of that fund, and then it functions as a juiced up curve strategy.
So USDS holders natively get higher yield because of this.
Totally. They get a completely juiced up yield. Curve returns 4% today, and auto yield we can sustain for another 6 months at 11%, assuming no more yield is generated. But every day we're generating. So.
Yeah, and I know on Beefy right now it's auto compounded at 8%. So this is even more boosted than an auto compounder is.
Totally. And the glory of it is you don't have to stake, you don't have to claim, you don't have to do anything. It's actually rebased back to your wallet. So rebase causes people.
Yeah, man, good times in Ample back in the day. Ample fourth.
Yeah, so the rebase, we took the best feature of Ample, which is this rebase tech, but we don't use the rebase for peg stability. We only use rebasing as a tool to distribute the yield in a way that doesn't cost any money. So now users get the yield, but they don't have to stake, they don't have to claim, they don't have to do anything.
That makes total sense. This has been awesome, man. Curious kind of what you guys have up in development updates, how our audience can get involved, and what you guys are working on now.
Yeah, for sure. So in light of the UST collapse, we're doing everything to ensure that our protocol is hyper secure. So we're launching a couple new yield farms. So they're going to be really, really juicy, and we got stablecoin farms coming out with Sperax on Curve. So we're super stoked to announce that partnership. By the time this airs, I'm sure that it'll be public. We also have a USDS SPA farm coming out. And then this morning we made a huge partnership public, which is we just signed a deal with StreetBeat. So StreetBeat is a fintech provider, and we're working with fintech platforms to deliver what we're calling the DeFi mullet. So we actually stole that term from the Bankless guys, so shout out Bankless. But what it means is, we can actually use USDS and DeFi protocols to deliver safe, reliable, and organic yield to fintech users. So we just signed a deal with StreetBeat. They got 50,000 users. Now 50,000 new users are able to connect their bank account, get USDS, and then boom, they got an 11% savings account ready to go. All they got to do is download something off the App Store.
Badass, dude. I love that. We're doing something a little bit similar, as you know, just kind of bringing yields to fintech users, traditional investors. So it's always good to see, keep them safe and protected and good high yields. So excited for that. Excited to see the DAO grow and get more involved with the community. It's been an absolute pleasure, Alec. Congrats on this success so far, and excited to kind of see this grow and help it grow.
Thanks, Andy. It was great chatting.
Not really sure where Rob went, but he'll be back. His Wi-Fi probably went down, but yeah, man, it's been a pleasure. So thank you so much for coming on, and it was a good episode.
Thank you, man. Have a wonderful day, and look forward to chatting.